Well, coming out of a long three-day weekend and into a new week, you're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant, with me, my colleague Sonia and Nigel. Guys, hi, morning.
Hi,
morning.
Good morning. Back after a long weekend and heading straight into earnings season. So it's going to be a rough one, right? But another long weekend coming up.
Yeah,
so.
that's
that's something to look forward to, perhaps.
The Friday's off as well, so four-day weekend. We're getting used to it, right? I mean, spoiling our habits.
Yeah.
So when we have to actually go back to the grind, the full 5-day weeks, I don't know how we'll take it.
I think there's another one coming up in May, right?
Yeah.
The 1st of May,
on the
right?
1st of May.
Yes. So this week we have 4. Next week we have 5 days working, and the following week again I think we have.
I think we'll manage, right? Nigel?
all of us look really well rested. Just slept, relaxed.
Amazed.
All right, let's just quickly tell you what you need to know as we begin another trading session. So you got the US market data, which actually did not disappoint. I'm talking about the Friday's jobs report, and this is important because we had a string of data disappointments through the course of last week. Monday, Tuesday, Wednesday, ISM services, the ADP report, the Joel's number, they were all sober, and the market very aggressively started to price in much greater degree of Fed rate cuts later this year, and practically a pause in the month of May, which is the next Federal Reserve meeting. Friday was a departure because the jobs data was not super strong. It was not very hot, but it did not disappoint. It was in line and in some measure even beat expectations. And that's the reason why I'm saying this is something to note. The May FOMC pricing, in terms of what the market thinks the Fed will do in the month of May in its meeting, moved up. Pre-payrolls, it was about 11 basis points. It's now 18 basis points. This is market pricing, which means, you're basically back at looking at about a 25 basis point hike after the payrolls data. The market pricing of interest rates also has moved up. So, you had the 2-year, which is the most closely aligned to what the market thinks the Fed funds will look like, which had dropped to a new low of 3.65, new recent low of 3.65% earlier last week. It ended just under 4%. So you got a bit of a repricing which happened. Now the next data point, which is the CPI number in the US, is the other big thing to watch. So there's jobs and there's inflation. Jobs has come in line, and the CPI number on Wednesday I think will be the final, in a way, decider. If it is about 0.5% higher month-on-month core CPI, I think markets will stay put on that 25 basis point expectation. If it is a big disappointment, I think you can see fireworks, but that's Wednesday. Now, coming to the market here, last 5 sessions, we basically had about a 650-point move on the Nifty and 1,500-point move on the Nifty Bank. That's about 4% on each of these indices. The small cap index, by the way, in the same period, in the last 5 sessions, is up 6%. And the mid-cap index is up some 3% or so. So the broader markets, especially the smaller cap universe of the market, has done much better. But the Nifty and the Bank Nifty have done 4%, which is not bad at all. 5 sessions is what we're talking about. Most economists, the big news flow on Thursday, the last trading session, was the RBI's non-hike actually. And most economists now believe that the RBI perhaps is onto a extended hold, extended pause. They may hike if CPI surprises. If growth slows down, perhaps we're looking at a cut as well. For the market here, it's not exactly a negative picture at all. You got constructive data points. Global markets are looking much better. The RBI has gone on a bit of a pause. Unless we see a big negative daily close, the trend for now remains higher. I said this on Thursday evening as well. For the Nifty, 17,615 is the level to watch. We're there. We opened much above that with about a 40-50 point adjusted higher close on the SGX. 17,615 is the 38% retracement of the entire fall. We breached that higher on Thursday by about 25 points. The high on Thursday was 17,640 or so. So that's the first one. And that, in a way, once we start trading above it, that becomes a bit of a support. 17,858 then is the 50% retracement of the entire fall from 18,887 levels, which is the all-time high. For the Bank Nifty, 41,200 is the first resistance, and 41,382 is the 50% retracement of the entire fall. These levels have not changed. Banks, by the way, underwhelmed as compared to the Nifty on Thursday. So we'll see. On the way down, the 40-day exponential moving average for the Bank Nifty stands at 40,519, and that's the level to protect on the way down if there are some jitters which start to come through. And of course, we are into the earnings season with this week with IT companies which will start to report. I mean, the street is divided, in terms of what will happen. Usually third quarter is the slow one, but this time many are saying that the fourth quarter, perhaps because of all that has been happening, maybe a little slow as well. Sonia.
Oh, absolutely. And I think that's the big focus area this week, right? You get into IT earnings with TCS coming up on the 12th. You have Infosys on the 13th. Then you have HDFC Bank on Saturday. So I know it's not going to be a long weekend for a lot of people. There are a lot of numbers to track as well. But that's going to be the big focus area this week. And I think it'll be the first time that you will get an indication of what FY24 is going to look like. So there's an expectation that Infosys could come out with a guidance for FY24. And in that context, it's not expected to be a good Q4 for the sector because of the macro uncertainty, of course. But so Jefferies, for example, has said that Infosys could put out a 5 to 7% year-on-year guidance, constant currency revenue growth, and a 21 to 22% EBIT margin guidance. That's going to be the big focus area for the market, whether there is any more pressure expected in the IT numbers. And, a lot of these IT stocks have been going in on the back foot ahead of their numbers. They've been underperforming, so keep that in mind. For our markets, I mean, the trend is on the upside, no two ways about that. The Nifty is now up almost 4% from the 24th March low of 16,945. So in a sense, that has become the line in the sand, 16,900 thereabouts. And the Nifty is also above the 200-day moving average of 17,511. So in that context, a lot of levels were scaled up last week. The bulls have definitely tightened their grip on the market, and the FIs have also bought in cash for 6 straight days now. It was a small amount on Thursday, about 500 crores thereabouts. But in the last 6 trading sessions, FIs have put together bought almost 5,000 crores. So the going is good, but now everything depends on the IT sector and the tone of, the managements. So that'll be crucial. But otherwise, it's a market that the bulls have tightened their grip on. So I guess that's something that can continue.
Well, that's right, Sonia. The Nifty is trading a little bit at the higher end of the band. You look at the band on the downside, 17,200, and on the upside, 17,700, around 17,800. That level's likely to get met with some resistance out there. But we're still on a buy on dips mode till that 20 DMA or the 17,200, 17,250 gets violated on the downside. What's heartening, though, is the broader market performance. And as we pointed out last Monday itself, we're kickstarting a new fiscal. So the small caps, they could bounce back, small as well as mid caps. And the breadth of the market has looked quite good. You want to see more of the same, because otherwise portfolios, they got absolutely hit, towards the end of last fiscal. So good rebound, sustenance is key. What are the FIs doing in the FNO market? Well, they added some long positions, close to 2,000 contracts, and mild shorts is what they cover, close to around 1,000 contracts or thereabouts. That takes the positioning, the short positioning, to around 82% odd. So longs are around 18%, not as bad as the 91, 92% odd. So some part of that short covering has played out. On the option side, 17,600 call, 17,600 put. Both of them were very, very active in trade. So it appears there's a bit of a short straddle that's playing out. That's you write both these two strikes. You pocket a premium of around 190 to around 200 rupees odd. And you're bracing for that range of around 17,400 to around 17,800. If it stays in the range, you make money. But that's a strategy that's playing out. The crucial levels to track, 20 DMA on the downside, as I mentioned, that's an important mark to hold out. But the 50 DMA, that's the near-term level you should be looking at. So keep an eye out on that in terms of support zones. Resistance comes in at around 17,700. On the Nifty Bank, remember, it saw a big spike up post the RBI pause that we got in from the governor. But, the 50 DMA, that's important on the downside. The high that we saw before we went into this long weekend, that becomes a bit of a resistance at around 41,300 odd. If we can get past that, you'll want it to move to around the 100 DMA, which is at around 41,700 odd. So just keep an eye out on that mark. SGX Nifty, adjusted for it, it's indicating a bit of a positive start. My guess is don't go to chase the opening, but buy on dips is likely to continue with that 17,700 as a bit of a resistance zone.
All right, Nigel, let's quickly tell our viewers what's lined up in the first half hour of the show. We will get you updates from markets across the globe. Rajat Bhattacharya of Standard Chartered will join us to discuss the global trade setup. Later, our research team will, as always, get you CNBC-TV18's list of top 10 stocks for the day. At 8:30, we do a fundamental stock analysis with our market expert, Anand Tandon.
All right, we have plenty of market views coming up through the course of the next 2.5 hours, and some positive views as well. On the equities front, first up, we have Gautam Dugar of Motilal Oswal Financial Services, who says there's some positive bounce back from recent lows. He says valuations are now quite reasonable for key indices. With earnings season about to begin, near-term market movement will be led by earnings, especially IT and financials. He also says tech earnings are expected to be weaker sequentially. He's positive on financials and consumption stocks and has moved consumption to overweight in their model portfolio. Gautam says within consumption, they like Metro Shoes, ITC, Titan. They've added Vedant Fashions and Indian Hotels to their portfolio. He says they've also added Godrej Properties to their model portfolio. So very interesting. Gautam Duggad was actually cautious for a while, and now he's turned optimistic. Of course, the market has also recovered. So as they say, markets make opinions. But, they've added a couple of new stocks in their model portfolio as well that we mentioned.
Absolutely. We'll discuss more on that in a while from now. Venugopal Garre of Bernstein also has a view. He says a peaking of rates or even visibility is positive for equities. He says in the near term, macro trends help them reiterate their rebound call for India equities in a broadly bearish phase globally. He goes on to add India's underperformance to emerging markets over the last 6 months will narrow with this rebound, which is the key call. Their view is that macro recovery from the lows and then a stay in a band for more extended period as global adjustments and absence of a shock will be much longer this time.
All right, in fact, Venugopal Garre will be with us on the show today at 9:30 a.m. to discuss in detail their rebound call for India. So that's the second view this morning. It's not even 8:30 this morning, and there's a big rebound call that has come through for the Indian markets. But for the rupee, let's get you some money market views as well. V. Prasanna of ICICI Bank says better than expected US labor data supported the dollar index, which was under pressure owing to a softer PMI data last week. He says while the approaching peak in the rate hike cycle favors a weak dollar outlook in the medium term, next inflation print will determine the short term. He adds the rupee is expected to trade with an appreciation bias, with the RBI smoothening volatility in the range of 81.40 to 82.40 for this week.
Well, on bonds, B. Prasanna says global yields that rallied initially last week on softer economic numbers retrace marginally post the strong US labor data. Back home, he says the MPC announced a relatively dovish pause, surprising the majority of market participants, which led to a sharp rally. He expects markets to trade positively amid steepening bias. He expects the 10-year benchmark bond yield to remain in a range of between 7.1 to 7.3%.
Well, we have a lot of stock-specific action, and we'll get to that in just a bit in our special Top 10 segment. But for the time being, let's run you through the list that we're looking at. IGL, MGL, GAIL, Tata Motors, Titan, Credit Access Grameen, Shobha, as well as Godrej Properties. All of them will be reacting to positive news flow, while on the flip side, you have ONGC and Adani Wilmar that will be reacting to negative news flow.
All right, Nigel, we'll sort of get to these stocks in just a bit, but let's get a few things out of the way. Globalists top of mind. Rajat Bhattacharya, a senior investment strategist at Standard Chartered. He's joining us now. Rajat, good to have you with us here. Thank you very much. Let's just pick up where the US left off in terms of data, which is the jobs report. The 2-year from about 3.65 in the US, the 2-year yield in the US has moved up to just under 4%. Is the market starting to price some of these rate hikes back in? And what does it mean for equities globally?
Hi, morning, Prashant. You're right that the job market data was, again, robust, right? Slightly better than expectations in terms of the numbers. Unemployment rate also fell further. So that, I think, adds to the expectations that Fed will keep going a bit more. So we are expecting another 25 basis points of rate hikes, like we mentioned last time. But that is almost it for the Fed. Why? Because underlying those data, we saw that there was this slowdown coming through in, let's say, the temporary help, which is an early warning indicator for the job market. So temporary health services is slowing. We also see the initial jobless claims, which has been a traditionally early warning signal of the job market. Initial jobless claims, continuing jobless claims, they are on an uptrend. They bottomed in around September last year, and they've been on an uptrend. So underlying those data, while the job market still remains robust, and that gives the Fed one more reason to hike in May, that the underlying data points to a pause thereafter.
So what does this mean, Rajat, for a market like India? There is this expectation that we are heading into a big recession as well in the US. if this rate tightening cycle, even if it does take a bit of a pause, both in the US as well as in the Indian markets, do you think given the recessionary situation, given the kind of broad-based layoffs that we're seeing, this market could head into another leg of a downside, or is the worst already priced in?
Yeah, I don't think the worst is priced in yet because the markets, as you know, equity markets and the credit markets are not yet pricing in a recession in the U.S. Those are the only two indicators across our, leading indicators that we watch for U.S. recession. The two indicators that stand out that are not pricing a recession yet are the equity markets and credit markets. So there's further downside in both markets that we see. Now, if the U.S. does go into a recession in the second half of the year, as we expect, I don't think any market across the world will be immune. But relatively speaking, we do see Asia as a standout. Asia is on a different trajectory altogether because of the China's recovery after their lockdown. And you see India still solid growth coming through. The one thing that we need to see is valuations, of course, within Asia, as we maintain all along. Valuations still are a bit expensive in India. They're cheaper elsewhere in China, elsewhere. So while Asia will not be immune, I think in equities, we should be better off being in Asia. In bonds, we see Asia as Asia dollar bonds as a top pick because, as you can see, anyway, the Fed rates have peaked, and across Asia, we've seen central banks peak in rates. You saw the RBI talk about pausing rates. So that's positive for bonds across the region in Asia.
All right, Rajat, final question before we let you go then. So would you pick bonds over equities at this juncture post the recent pullback? And also we have a big CPI print that's going to be coming out, right, in the next couple of days. How important is that? What are you factoring in?
Yes, bonds over equities for sure. How often do you get to say that in a year? Very rarely, right? So this is the year when bonds are likely to beat equities, and that more so like places like India, where you see, so RBI peaking in rates for sure. In terms of the CPI data, we are seeing headline CPI having peaked and coming down, but core CPI still remains elevated. About 5% is expectations, right? So, which is the reason why the Fed is going to be reluctant to stop yet. So that's why we expect another 25 basis points of hike. But as I said, underlying data in the U.S. across the board seems to be slowing. And especially after that banking turmoil saw in March, we are likely to see banking lending conditions tighten further. And that's going to filter through into data in the coming quarters. So as a result, you're probably going to see, the CPI, core CPI also decline, but not just yet. Core CPI still remains high for the Fed to hike one more time.
Okay, so you're saying that the worst perhaps is not over for the equity market. So this is not a good time to be buying or putting money to work in a market like India, right? Correct. I mean, I would actually, it's a rare opportunity to buy bonds. I mean, this is the time to adjust your portfolio, buy bonds. RBI is telling us that it's almost peaked. It could raise one more time if inflation stays, high. But that's not what we heard last time. It was a surprise, right? So they paused. So it's a good time to buy bonds. And that's the case across Asia. You've seen Korea, Taiwan, Indonesia, Malaysia, all these central banks have been pausing. You've seen other central banks also pause. So it's a great time to buy bonds, not so much equities. Okay, great time to buy bonds, not so much equities. Got that. Rajat, thanks a lot for stopping by and giving us quick thoughts on CNBC-TV18. Let's slip into a quick break. Lots of stocks in focus, so many business updates that have come through. So we'll get you more on the fine print in just a bit. Stay with us. Well, we've got a lot of big cues to watch out for this week, but our research team is standing by with CNBC-TV18's list of top 10 stocks for the day. First, on the gas price revision and the latest on that front, Sonal is here to give us the lowdown. Sonal, over to you.
Good morning, Sonia. Well, yes, it's a big update and a material change that we have seen in the gas pricing regime. Now, the government has gone ahead, accepted the credit panel recommendations, and it means that now gas prices will be revised every month versus 6 months earlier. Also, prices will be pegged at 10% of the Indian crude basket versus formula-based pricing earlier. Also, there's a floor now to gas prices at $4 per MMBTU and a ceiling at $6.50 per MMBTU. Now, important to note that the ceiling is only for FY24 and FY25, following which there will be an addition of $0.25 per MMBTU every year. That is on the ceiling. Now, what is the impact here? All these city gas distribution companies will see a positive reaction because, especially for IGL and MGL, majority of their volumes come in from CNG and PNG. For MGL, there's an 87% exposure, IGL at 80%. Gujarat Gas has more industrial volumes, so CNG and PNG is the 36% of overall volumes. Now, on the back of this, Jeffrey says that IGL, MGL and GAIL are the biggest beneficiaries in this case, and that's why they've upgraded the EBITDA estimates across all the city gas distribution companies in GAIL as well. For IGL by 20%, for MGL by 19%, and for Gujarat Gas by 6% for the next 2 financial years as well. For ONGC in Oil India, IIFL says it's a short-term negative. There could be a hit on realizations to the tune of 24%, but of course, the ceiling is something, the floor is something that is beneficial for all these gas producers. For GAIL, IIFL says LPG segment will see a benefit because they use gas as raw material and it will increase their PAT by 3%.
All right, thanks a lot for that. We'll watch out for all of these stocks, but we're also looking out for Tata Motors this morning. The company reported its Q4 JLR numbers over the weekend and the numbers looked good. The total global sales for Tata Motors in Q4 has risen 8% year on year. The global passenger vehicle sales are up 10% compared to last year. But if you look at just the Jaguar Land Rover numbers, there's a very good growth compared to, on a quarter-on-quarter basis. JLR numbers have gone up 19%. They've reported 95,000 units compared to 80,000 last quarter. So looking pretty good on a quarter-on-quarter basis over there. Now, Goldman Sachs has upgraded Tata Motors to a buy from a neutral to factor the improving Jaguar Land Rover outlook. They've also gone ahead and raised their 12-month target price on the stock to 550. And they say that on a valuation parameter as well, the stock is looking pretty good. In fact, the stock now trades at 7.5 times price to earnings compared to its own historic median of 9 times. So it's cheaper than its own historic median. BofA Securities also put out a note where they say that the volumes were really good in Q4. It's a free cash flow beat as well. They maintain a buy target price of 475 and they say that the risk reward is favorable at current levels. So I'm going with green for Tata Motors.
All right, Sonia, we'll keep an eye out on that one. Now, Titan is the next one. Pre-quarterly updates. Mangalam is here with details. Mangalam.
Well, decent update coming in from Titan this time around. 23% growth in their jewelry business. This comes on a feeble base. Remember, same time last year was the Omicron wave, as a result of which their jewelry business grew by just around 1.3%. But, the growth this time around, the real star of the show was their non-jewelry business, where watches grew by 41%. Emerging businesses, which include the likes of fragrance and Tanera, grew by 80%. In fact, their sari business this time around grew by 208% itself. So as a result of which, their overall revenues in the quarter were up by almost 25%, which is higher than other peers who have reported their numbers itself. Large ticket purchases for the company have been led by a rich mix of high-value studded jewelry and solitaires. The only fly in the ointment, however, is that the sharp rise in gold prices in March led to softness in demand. So January and February were good, but March was a little soft, and maybe the street believes that April will be a little soft as well, as a result of which I see the stock opening in the green, but difficult to retain those gains.
Okay, all right. Thanks a lot for that, Mangla. Well, let's hop across to Abhishek. He's tracking Credit Access Grameen. Hi, Abhishek. Good morning.
Morning, Nigel. So, Credit Access Grameen have given their business update, and in line with what peers are showing in terms of, momentum being stronger than expectation. So, disbursements are up nearly 24% YOY and about 48% quarter-on-quarter. The AUM growth is robust at 26.7% YOY and more than 18% quarter-on-quarter. Disbursement to AUM ratio, now that's a point to note, given the fact that for an MFI player to have a 45% disbursement to AUM growth, it is almost in line with what HFCs or fixed asset financiers do give out. Calculation shows that the average ticket size is up 12.3% YOY and more than 18% quarter-on-quarter. This is despite the fact that, customer growth is flat on a sequential basis. Back to you.
All right, thanks a lot for that. Well, let's go back to Mangalam now to find out more about Adani Wilmar and how the performance was this time around. Mangalam, over to you.
Well, we saw it in Marico's update where their edible oil business did not do well on account of two factors. One, there was a high base in the same time last year, and secondly, the prices of edible oil have cooled off drastically. So that's what's reflecting in Adani Wilmar as well. Edible oil volumes were flat year on year, whereas value decline has been in mid-teens. In fact, the overall revenue decline for the company this time around has been in high single digit, and that's because their other smaller businesses have done extremely well. Food and FMCG, where value growth has been 60%, volume growth has been 40%, and industry essentials as well, where the value growth has been in low teens. The company said that the supply of imported edible oils have been smoother during the fourth quarter, and oil business, however, has been dragged by lower demand by the bakery as well as frying industries. So see some red purely on account of the weakness that we're seeing in their core business.
All right, thanks a lot for that. Mangalam, well, Sonal's joining in to tell us about a couple of operational updates, Shobha as well as Godrej Properties. Morning, Sonal, go for it.
Good morning, Nigel. Well, yes, good updates coming in from both the companies. For Sobha, it was the highest ever quarterly bookings that the company has seen. So overall, their Bengaluru market saw flat sales on a YY basis. NCR saw a dip, but Kerala was the one which saw good growth leading to this number this time around. Sales value was up 26% on a YY basis. Sales volumes were up 8%. And it was driven by realizations as well. So realizations for the company went up by 13.5%. The same story with Godrej Properties as well. Strong update, both quarter on quarter and on a YY basis. They have reported strong sales growth. So 25% on a quarter on quarter basis in terms of sales value. Volumes are up 19%. Collections have gone up by 127% on a sequential basis. And on the back of this, the company has been able to surpass their FY23 sales booking guidance. They had guided for 10,000 crore rupees. They have been able to do bookings of 12,232 crore rupees. So definite green on Godrej Properties.
Okay, so they also say in their press release, with our business development additions nearly doubling our initial guidance and increasing by over 200% year on year, we have a stronger launch pipeline in the current year than ever before. So very positive, commentary coming in from Godrej Properties as well in their press release. Thanks a lot, folks, for updating us on the numbers. Well, let's get you a quick recap of our top stocks with positive news flow. IGL, MGL, GAIL, Tata Motors, Titan, Credit Access Grameen, Sobha and Godrej Properties, while stocks with negative news flow, ONGC and Adani Wilmar. But also, let's get a quick update on what's happening in the world of commodities this morning. Manisha Gupta is joining in for all the roundup, of the action that took place in the last couple of days that we perhaps missed out on. Manisha, good morning.
Morning. Thank you for that, Sonia. Well, after 3 weeks of gains, the crude oil prices have started a fourth week on a positive note. We are holding around 81 for the WTI and 85 plus kind of levels for the Brent crude prices. Also, we've seen 7% of gains come in for the previous week. The OPEC plus output cut, the sentiment from that is holding the prices firm. And the latest is that the Saudi Arabia has now hiked the May crude oil prices for its consumers in Asia and US. So that tells you that the demand is coming back and Saudi Arabia can deal with higher prices there. What we have seen support come in for also is the natural gas prices. Last week was a 5% decline, but we have seen prices gain up as the demand in the Western world continues to rise. Also, the fact that you will be soon getting into the summer driving demand season in the Western world, and the US is expecting higher demand because of that as well. To the metals then, and that seems to be under pressure for most of them, barring copper, which is trading at around 2-week highs because of tight inventories and lower supplies from Peru and Chile. You have zinc trading at 5-month lows, steel trading at a 7-week lows, iron ore at 3-month lows. So metals clearly is a mixed bag with only copper trading in the positive side right now.
All right, Manisha, thanks very much for that. So that's commodities, a quick picture for you. Up next, Anand Tandon will be with us for some fundamental stock analysis. Later, we'll connect with Kirit Parikh, chairman of the Integrated Research and Action for Development. The panel recommendations were approved. Harshvardhan Dole of IIFL will also join in to discuss the APM gas pricing norm. Stay tuned. That conversation coming up next.
Welcome back. Hope you're having a good morning. Well, for starters, the SGX Nifty suggesting that after a nice long weekend, we're likely to see some more green to kickstart trades. So let's hope that is the case, and hopefully the bulls will be hoping that can hold out. But let's discuss a couple of stocks then. Market expert Anand Tandon joins us on the show. Hi Anand, good morning. Thanks so much for joining in. Anand, today we've got a couple of operational updates coming in from some realty players. both Godrej Properties as well as Shobha. What's your view on the real estate space, and if at all, any particular view on both these two stocks?
Well, incrementally, Nigel, the news has been positive, right? Because now that you are not expecting serious increase in interest rates, the demand was already quite robust, and the only fear that one had was that whether it will get dulled down because of the increase in mortgage rates as interest rates go up. That has been taken out of the calculation for the near term. And with that, there is no particular reason to assume that demand will not continue to remain robust, at least for the next couple of quarters at least. And the commentary that you are hearing is also indicative of that. I think the longer term picture is that at least, for example, in some parts of the south, the housing starts, as they are called, have actually slowed down somewhat over the last quarter or so. But that doesn't mean that over the next year or so, there will not be enough new supply coming in as well. So I would expect most of these companies to report very robust numbers.
The other stock that is in focus this morning is Tata Motors, Anand. There is an upgrade coming from Goldman Sachs this morning. We just spoke about that. The thesis of their upgrade is A, valuations are looking much better than even the historic valuations that Tata Motors has been trading at. And B, starting 2025, Tata Motors will be introducing electric vehicles in both Jaguar and Land Rover brands. And, the pipeline is looking very strong. Do you think it's a good time to be buying the stock?
Well, I think, the domestic market, if you look at Tata Motors, they have actually improved their portfolio very considerably, and so has the performance. In the international markets, I think there are two issues that you may want to consider. One is that the order book that remains has kind of trimmed down quite considerably, and while the companies is indicating that they've been focusing on making sure that they meet some of the old orders, the reality is that if new orders pipeline doesn't pick up, that becomes an issue. And given that much of their sales happens, or at least a significant part happens in Europe, there could be issues going into the second and third quarter of the calendar year for the demand slowing down considerably there as well if some of the recession fears comes through. That aside, the positive is that the debt will come down. Hopefully, maybe £1 billion almost coming off, and that will certainly help in increasing the equity valuation of the company. So, a long story short, valuations are now reasonable. I think earnings growth will be quite strong this year. Tata Motors can be part of your portfolio.
Anand, good morning. One is your thoughts on the companies like Barbecue Nation. The stock had a big move, some 13-14%. That entire pack actually has been quick service formats have been under a fair bit of pressure. Do you see any turnarounds here? And then, if you will, comment on NBFCs. Chola Finance had a very good day last Thursday, which was the last trading session, and so did many others in that space. In the light of what the RBI has done, which is a pause. Go on.
So clearly, as far as NBFC is concerned, it is a positive, right? Because if wholesale rates are not going to be moving up as much, the big fear that I had at least was that, this would be a year where collecting deposits will be far more important than putting up assets. It does remain that, given the fact that credit growth is coming through in a very robust way, you would need to, pick up the liability side as well. But now that you've put a pause on in terms of where the interest rates will go, it means that to some extent, that will become less of an issue, perhaps. That said, between NBFCs and banks, I would still prefer banks with strong liability franchise. But among the NBFCs, there is no question that Chola is one of the best companies that you can get and has managed to deliver very strong performance for many, many quarters consistently. So from a perspective of, a slightly longer term view, Chola is something that you may want to look at. On the QSR, I think if you are looking at consumption space, I would have preferred so far the rural space much more than the urban, where QSRs operate largely, because of the fact that one is expecting to see much better rural incomes. And, though there are fears of monsoon not being so good, I think what the fact is that given the prices at which you would be trading some of the commodities that you'll be producing, you should be making reasonable amount of money. And also the fact that many of the states have, election years, so many of the subsidies and programs of the governments would be pushing money into the rural markets. So between urban and rural, I would prefer rural plays rather than urban plays. And consequently, you look at focusing on things that can be driven by rural demand, like tractors, two-wheelers, perhaps. I think two-wheelers is something that has been beaten down quite badly. And though it has seen some recovery in the last few trading sessions, etc., I think there is perhaps some more space there.
Okay, all right. Anand, I want to ask you about Godrej Consumer. We had the management a couple of days ago on the channel. And, the last quarter was a little bit rough, but they're guiding for better things in the coming year. Your view on that stock?
So, there has been a change there in the management, and therefore you would expect to see that, there will be a period over which there will be some changes that the management has to make, and after which you would expect to get much better performance. We haven't yet seen significant improvement yet, especially, in some of their core portfolios. Overall, I think if you are looking at buying consumer at this stage, again, as I just was trying to make a case for buying rural, you would look for rural players to some extent because of the, the anti-mosquitoes and so on, things like Godrej has, they would also be partial beneficiaries. But I would think companies like Dabur, etc., may be slightly better placed.
Right, we'll come back to you in a bit. The other big headline was that the government has accepted the suggestions of the Kirit Parikh panel on gas pricing. To discuss it in detail on the new revision in the gas pricing norms, we have Kirit Parikh, the chairman of the Integrated Research and Action for Development. And we also have Harshvardhan Dole, who's the vice president of institutional equities at IIFL, joining us now. Gentlemen, morning to both of you. Mr. Parikh, good morning. The last time we chatted, you mentioned that these will definitely go through. It's just a matter of time. But tell us on the new gas pricing norms, what are your thoughts? Anything that should have been added? And I also understand that the policy has not mentioned pricing freedom anywhere for APM pricing. Would that be a bit of a concern for you?
No, I think it is the APM prices recommendations that we had made were following that it should be fixed within a floor and a ceiling price. And that is accepted by the government. The same floor and ceiling we had suggested, $4 per million BTU and $6.5 per million BTU. At the same time, the gas price for APM gas has been linked to the import price of crude oil in the previous month, and that is what has been done, and that has been used to set the price of gas, which is around $8.35. But because of the ceiling of 6.5, APM gas is now at $6.5, which is less than the current prevailing price of more than $8. So I think the consumers will are getting cheaper price for the PNG and CNG supplies. That is the piped natural gas for domestic users and compressed natural gas for transport sectors. That is now cheaper than what it was 3 days ago.
And
the second
sorry, go on, sir.
The second measure the government has taken is that it has provided 20% additional money or price increase for gas that is produced by ONGC and OIL from fields which are not part of the allotted fields, but other fields that they own. And from that, whatever they produce, they will get 20% more price. So that's why I think that they have not yet taken any decision on total pricing and marketing freedom for the rest of the companies. But I think that the price that they have said would sort of help benefit others as well.
Okay, Mr. Parikh, first of all, congratulations on these recommendations going through as you'd suggested. We spoke last week as well when there was a bit of a sort of doubt whether they'd be taken up, but you sounded confident that they will be, and they have been. So congratulations again. Harshvardhan, good morning. Now, what does it mean for city gas companies? Because this is straight away a complete pass-through, right? Does it come through? Is the benefit will come through via higher volumes? What's your sense?
Well, firstly, sincere congratulations to sir for recommending such balanced report to the government and government accepting that. Clearly, all the city gas distribution companies, if you notice over the weekend, have cut the CNG and domestic PNG prices by approximately 10 to 12%. And that improves the attractiveness of CNG as well as domestic PNG versus liquid fuel and the packed LPG cylinder. And to that extent, when the outlook on volume is fairly robust, the pressure on raw material prices is easing out. And it appears that at least over the next 2 to 3 years, these companies are well poised to gain from the cut in the raw material prices. We continue to like these companies and think that, rather than owning some of the heavy upstream companies, whereas there is uncertainty in terms of commodity prices, it makes sense to buy these and hold for, earnings growth linked stock price appreciation. IGL actually is our top pick in the sector.
All right. Hi, Harsh. So clearly it's positive for that set of stocks. But what about the gas producers? Near-term negative, right? But overall, are you still positive on these stocks?
Well, basis the recommendation that sir has given, it appears that pari passu, there will be about 8 to 9% cut in the EPS for ONGC and OIL. But bear in mind, the earnings are extremely sensitive to the underlying oil prices. For example, a $5 swing leads to almost 10% change in the reported numbers. So these are the cut as of now, and we'll track it progressively. But having said that, see, even after the earnings cut, the upstream companies offer a dividend yield which is as high as 8 to 10%. And to that extent, these could actually be good portfolio allocations in choppy markets as we are witnessing. So I don't see these stocks collapsing like pack of cards. They may underperform the CGDs, but given the size, etc., these could be good portfolio allocations.
All right, got that. So there's no collapse in these stocks as such that you're expecting, Harsh, got that. Mr. Parekh, you spoke about how the ceiling has been set at $6.50 per MMBTU. You'd also indicated that a $0.50 increase to the ceiling every year is something that perhaps, could be taken forward. It has come in at $0.25. Will that be good enough to compensate the gas producers?
The logic behind giving half a dollar increase every year was that we were expecting at that time that the Ukraine war will come down and the international prices of gases and other things will more or less stabilize. And then it would be ideally one would like to move towards as much of a free market determined prices for all gas producers as possible. So I think $6.50 would give enough time for people to adjust to them. And anyway, if the crude price is less than that, then the domestic price will be less than this was only the ceiling that was being raised. So I think going to $0.25 increase periodically is perhaps a sensible step that the government has taken in the light of the uncertainties about the Ukraine war and the international crude and gas prices.
Got that. Harsh, what are the hurdles or problems with moving fully to this free pricing regime, you think?
Sure.
Harsh?
So in my opinion, the government should ideally move to the free pricing gradually because there are a lot of sectors which are price sensitive. And for example, fertilizers, which consume bulk of gas as of now, the prices are controlled. And to that extent, the subsidy bill for the government may actually go up. So while liberalizing the gas prices, government has actually to walk a tightrope. It has to ensure that the producers get fair compensation. But at the same time, the price sensitive sectors also don't end up paying much more. So I think the government has bought itself 2 years to ensure that these things can be adhered to and a risk reward can be fairly maintained.
Harshvardhan, let's assume that international oil prices remain around $85 to $90 a barrel in a sort of long-term contract with a 10-12% kind of slope to those prices be feasible for Indian city gas companies? Or you think they'll have to largely depend on domestic APM gas? What's your sense?
See, if you break down the overall gas consumption in India, 50% is domestic and 50% is LNG. And within that 50%, by and large, if you were to take last 5 years average, bulk of it is coming from term contracts. And these term contracts are, combination of either Henry Hub or essentially linked to oil cargo. With the establishment of, domestic prices which are linked to Brent, I think companies' ability to import Brent-linked cargo has actually gone up significantly. And to that extent, I think the bargaining power of the domestic consumer or the bulk buyers such as GAIL, GSPC has only gone up.
Okay, all right. We'll leave it there. Harshvardhan, great to have you with us here. Mr. Parekh, congratulations once again from all of us here. Thank you very much for speaking with us here on CNBC-TV18. So that's, the oil story, which has now come to fruition in the sense that the panel recommendations have been accepted. We remember last week when we came, on the first actually, when we started the new financial year, stocks all sold off, city gas companies all sold off before recovering fully by the end of the week. And now, of course, we've got this in terms of news flow to react to. We'll slip into a quick break. Let me tell you what's lined up over the next 30 minutes or so. So Anuj will join in the studio with a quick trade setup in terms of how he sees things. We'll get you the top stocks for the day from our technical and futures and options experts, and we'll decode the stock rally in our Momentumizer segment. We put the spotlight on one or two names which should be in focus. And before market opens, CNBC TV18 Stock Board will highlight top stocks and news to focus on for the day. Stay with us. Okay, welcome back. So we're going to start another week, holiday shortened week that is, but it's going to be, I think, a decent start. Adjusted closing is still indicating a slightly higher start on the SGX. Anuj is here with the quick check on how he's seeing things this new week. Anuj, hi, morning.
Morning, Prashant, Nigel, Sonia. It's been a good rally for the market over the last 1 week or so. And what it's done is it's taken the Nifty back in that zone. I mean, if you see the trend line that I keep talking about, this is the trend line, and every time the market's gone there, the Nifty, it's taken a halt there. But let's see if this time it can take it out. FI shorts are down by about 90,000 from peak, still hugely short, and mid caps have started to participate in the rally. The Bank Nifty has taken back leadership, so I think this perhaps is as good a time as any to attempt a breakout from this channel and perhaps even make a move towards who knows, all-time highs. Now, the Nifty, of course, has managed to negate a major death cross and has rallied 750 points from lows. The texture has changed to buy on dips from sell on rally, and the broad range is 17,430 to 17,770. And the Bank Nifty is stronger. On Thursday, of course, there was some profit taking post the RBI policy, but otherwise it's been a very strong index trading above all its major moving averages, and it's just now about trailing the stop loss. 40,500 is the most important support for the Bank Nifty. But my sense is, going by the data, that maybe even an all-time high is possible on the Bank Nifty if you're able to take out this channel and negate this last 100, 200 points on the Nifty. Then with the leadership from Bank Nifty, maybe you make a decent move in April and May.
Okay, that's perhaps a positive sentiment that we needed, Anuj. Now that you're back, the market has been chugging along, but that extra push has come in from you. So good to see you.
One reason that I have a positive bias is that I want the market to continue the rally, because otherwise, normally when I come back, people say that, okay, good to have you back. I don't want a trend where people say, okay, why did you come back? So that's also perhaps a reason.
Never gonna
I have
happen.
a bit of a positive bias.
All right. Thanks a lot, Anuj, for joining in, and welcome back. But let's also get our technical experts on board to tell us if this uptrend is something that can continue. Mitesh and Sudarshan are with us. Gentlemen, morning to both of you. Sudarshan, it's been a good run, right? I mean, 4% from the lows that we saw in March. Are there more legs to this rally?
Yeah, good morning, Sonia. I would think so.
We are in an uptrend, so we don't question that uptrend. It's after so many days last week that I could easily say buy on dips, and I hope that continues. Now, clearly, small gap ups have to be patiently waited on, and you'll get these intraday dips, intraday consolidations. The only trade is to go long in these trades. I would also suggest you keep some positions as a positional trader, which you don't dabble into during the day. Just keep them as a long side position. For the Nifty, at least, the market has no resistance till we reach 17,800. That's an approximate line. It's a zone actually, but I'm just giving you an easy number. So every dip is a buying opportunity. We'll assume that the rally has more legs.
Okay, all right. Thanks for that, Sudarshan. Mitesh, what about you?
Morning, Ajay. Last few days, I've been maintaining a very similar kind of a bias. So the zone which Sudarshan indicated, 17,800. I have been looking at 17,780, 820 zone. I think that's fairly a very similar number. I think overall the market has given a good reversal on the hourly, 2-hourly, and the other short-term charts, and I think this should at least see us test 17,800. Therefore, any 50-60 point decline, welcome buying opportunity. On the downside, 17,450, 440 is an area which I think would act as a good support. So closer to that, if you can buy it, I think even better. And on the stock side, clearly trade with long bias. We have in fact all buy calls today. So last 3 days, the tide has changed from sell and rallies to buy and declines, and be long on stocks as well.
Okay, long on stocks, that's the magic word and the cue that we're going to take. Mitesh, what are the stocks that you're looking at this morning? A lot of positives, right? I mean, the real estate companies which are doing very well, auto stocks, there are upgrades coming through. But technically, what do you like?
Morning, Sonia. In fact, I do have a real estate and an auto name in my list. I think overall it's an all-buy list. DLF is something which I think has triggered a good trend, could head towards 415, 420 positionally. But in the short term also, it's a buy with the stop below 375 for a first target of around 400. Bajaj Finance is a buy with the stop at 58.40 for targets of 6,100. Disclaimer, we have some call options positions here. Sun Pharma is my third buy call. I'll suggest a stop just below levels of 1,000 and a target of around 1,040 to begin with. And Aarti Industries, that's the final buy call. Keep a stop below 524. Look for targets of 560.
Sudarshan, what about you?
Well, there are a lot of good quality stocks that are finally looking up from their mini bear markets, from their sideways ranges. HDFC Life is a buying opportunity with a stop under 493. You know, traders who keep these positional trades will actually be big winners rather than intraday. But then it's a choice. Tata Power is a buy. They had a very nice 4-day rally with gaps, and that's a buy with a stop under 192. I also have an intraday short sell, Britannia. That's a stop above 43.30. Always intraday if you are shorting. And ACC is it's giving signs that finally it's putting its act together. I think it's a little early, but it's worth finding out. So that's a buy with a stop under 1680.
Okay, all right. Interesting list of names as always. Sudarshan and Mitesh, appreciate you joining in, and we'll get you back again with your 9-10 calls in a bit from now. We'll take another quick commercial break here. We are back with the pre-open session. We'll also have Umesh Revankar of Shriram Finance to talk about the RBI's decision to not hike repo rates as was widely expected. That was, of course, on Thursday. Stay tuned. That conversation coming up.